Good day and welcome to Stock News. I'm Robin, and today we're taking a closer look at how the Trump administration's focus on containing long-term U.S. Treasury yields is fueling speculation about a potential review of the Supplementary Leverage Ratio, a key banking regulation that affects how much capital major financial institutions must hold against certain assets. What is the Supplementary Leverage Ratio? The Supplementary Leverage Ratio, SLR, is a post-financial crisis rule requiring large U.S. banks to maintain a certain level of capital relative to their total leverage exposure, which includes on and off balance sheet items. This additional capital buffer is meant to ensure that banks remain resilient, even if they hold assets considered low risk, like U.S. Treasuries or central bank deposits. Under the current rule, banks still have to set aside extra money for these holdings, effectively limiting the amount of government debt they're willing to purchase or keep on their balance sheets. Why might it change now? With President Donald Trump reportedly aiming to keep long-term Treasury yields contained, market expectations are growing that regulators might revisit the SLR. The rationale is simple. If the rule is eased so that banks don't need to hold as much capital against Treasuries or central bank deposits, it could encourage banks to buy or hold more government debt. Increased demand for Treasuries could, in turn, help push yields lower, aligning with the administration's goals of containing borrowing costs. Implications for the markets. Some traders see a policy shift on the SLR as a potential game changer. By reducing the cost of holding Treasuries, large banks would be more inclined to absorb additional U.S. debt, thereby exerting downward pressure on yields. This could be particularly relevant if other economic factors, such as inflation concerns, are also influencing the Treasury market. However, critics caution that rolling back capital requirements might reintroduce systemic risks the post-crisis regulations were designed to mitigate. Looking ahead. For now, this remains speculative. Any concrete move would require regulatory review and possibly legislative steps, and we're still awaiting official confirmation of any changes to the SLR. But for investors and market watchers, it's an important development to track, especially as the administration continues to emphasize stable or lower yields and banks weigh how to best navigate evolving capital requirements. Thank you for joining me on Stock News. I'm Robin. Don't forget to join our free newsletter. The link is in the description below for more market insights and updates. Stay tuned for more in-depth analysis and have a great day.